Retail traders today have access to zero-commission APIs and the exact same charting software used by Wall Street. Yet, despite these institutional-grade tools, retail failure rates remain exceptionally high. The data reveals a stark reality. Looking at 3-year profitability rates, professional traders sit below 8%. Retail day traders hover around a mere 3%. When practitioners blow up their accounts, they usually blame their setups. They assume their technical indicators were flawed, or their execution speed was too slow. The vast majority of drawdowns actually stem from unforced behavioral errors. The human brain is simply not equipped to handle the environment modern brokerages have built. Modern trading interfaces are engineered to deliver a continuous stream of flickering prices and instant execution. Every single time you recognize a pattern and click your mouse, your brain releases a hit of dopamine, creating a biological feedback loop that rewards impulsive action. Once trapped inside that loop, traders fall into predictable cognitive traps. They suffer from the disposition effect, holding losers too long and selling winners too soon. They overtrade to chase the hit and invent narrative biases to justify their irrational decisions. To survive as an independent practitioner, you need a deliberate countermeasure. You must build an architecture of constraint. This architecture is a rigid system of self-imposed restrictions. It is designed entirely to limit your data intake and neutralize your capacity for human interference. Traders generate long-term profitability by engineering a highly restrictive environment that mathematically limits their ability to sabotage themselves. The first layer of this architecture is psychological framing. It starts by treating the markets as a secondary pursuit or a serious hobby. Relying on trading to pay your mortgage or fund your retirement creates a pressure that distorts judgment. Removing the need to generate primary income immediately reduces the fear-based, irrational decisions that erode a portfolio. Consider a trader we'll call Joe. He is a 25-year veteran of institutional energy desks, a highly intelligent practitioner who manages 2 distinct personal portfolios. His first portfolio is a chaos account. Here, he tracks multiple timeframes, mixes futures contracts with high beta momentum stocks, and operates under an enormous cognitive load. Despite his institutional pedigree, the financial outcome of this chaotic approach is zero. For 4 years, this account has remained entirely flat, trapped in a cycle of 2 steps forward and 2 steps back due to constant overstimulation. His second portfolio operates under strict rules. He calls it his magic account, and it relies on a single, repetitive strategy, using option spreads. The structural constraint here is time. Trades are held for 2 to 5 days, and they are closed out automatically if the initial position loses 50%. He removes all intraday management. The financial result of this highly constrained account is consistent, compounding profitability. He puts the trades on, goes to work, and leaves the market alone. Intentionally extending your time horizon and narrowing your asset focus acts as a powerful structural filter. It neutralizes the dopamine-driven noise of intraday price action. If you choose to execute intraday, you have to apply the second architectural layer, temporal parameters, or chunking the data. This requires abandoning the continuous all-day screening of the market. Instead, you restrict your exposure to a single predetermined time block. For futures, optimal structure begins precisely at 8 a.m. Eastern. We map the open relative to previous day's high and low pivots. Placing automatic stops outside the first 20 minutes captures the breakout. Once triggered, the position is closed exactly 15 minutes later. This artificial boundary prevents the slow drain on your capital that happens when you try to capture every minor fluctuation throughout the trading day. Restricting your execution to a single high-probability window mathematically eliminates the risk of afternoon behavioral tilt and decision fatigue. The final, most extreme architectural layer relies on purely mechanical systems to eradicate discretionary thought entirely. We see this strict constraint in volatility expansion models, relying on logic popularized by traders like Bob Burren and Toby Crable. We isolate 90% of the previous day's range, projecting it from the close to establish blind stops. It forces uncomfortable executions, triggering long at the high, then aggressively reversing to enter short. Rigidly holding catches a massive downside trend, covering the loss exponentially. Statistically, this mechanical model boasts about a 65% win rate, guaranteeing frequent and frustrating whipsaws along the way. Mechanical constraints exist to force you to hold through psychological discomfort, ensuring you capture the outlier trends your emotions would have otherwise abandoned. To keep this architecture intact, a trader must maintain a strict feedback loop of physical accountability. Many of the most successful market practitioners rely on a rigorous analog process. They meticulously log their daily bottom line, market internals, and pre-market plans entirely by hand. Exporting a spreadsheet from your brokerage software does not correct behavioral drift. You read the numbers, but you don't absorb them. The analog friction of physically writing forces a cognitive slowdown. Putting pen to paper interrupts the screen-induced dopamine loop and demands real reflection. Maintaining a physical ledger forces you to stare down your unforced errors objectively, day after day. You cannot hide from a negative bottom line when you have to write it out yourself. This completes the architecture of constraint, expanding your psychological horizon, chunking your temporal exposure, and relying on mechanical triggers. Executing this architecture requires accepting boring consistency. You have to abandon the search for a perfect, infallible indicator. Practitioners manufacture trading alpha by relentlessly executing a constrained process where, eventually, the mathematical variance takes care of itself.